Location is also very important, and location of the property will determine different loan-to-value ratios, and there are postcode restrictions in every major capital city in Australia. There are suburbs in specific areas where lenders don't like those particular suburbs. It could be because in the Gold Coast, for example, there are places where there's a risk that there could be a large number of properties on the market at the same time, and they're identical properties. So anything that has a postcode restriction, I'll be very wary of, because that's telling you that potentially if something happens, you could be stuck with a property with hundreds of other investors. That could be one reason why there's a postcode restriction in terms of lending. Metro residential property. So your typical suburban home in your typical suburb is just the easiest property to obtain finance against. Residential zoning 1, just nothing special. So this is the most common type of asset that lenders, banks, financiers love lending against. Why? Because it's the most liquid type of property. There's more of them sold every week than any other property on the Australian market. So if you target properties around the median price, around major capital cities in Australia, within 5 to 35 k's of the CBD, you'll be fine. That's pretty much, as a general rough rule of thumb, that's pretty much the kind of properties that you probably find won't have many lending restrictions. But once again, this is a very rough guide. And if you are buying a property, I encourage you to ring up 21st Century Finance and just have a chat to them about the property, see if there are any restrictions on the particular property, whether it's size, zoning, or the postcode. Just a phone call to check it out. And this is the thing with property, guys. If you make a mistake in property, it's tens of thousands of hundreds of thousands of dollars, usually. I haven't seen property mistakes with just $1,000 or $5,000. It's usually tens of thousands and hundreds of thousands of dollars. And the biggest thing is it's the opportunity loss of time. Because people do something, they're not really understanding what they're doing, and they lose so much time because they've stuffed up the structure, the banks have cross-securitized them, they've bought the wrong property in the wrong area, and then they've got to wait for 10 years or 7 years before they do something else. So getting the knowledge is really the best thing you can do for yourself, getting educated and then knowing exactly, and getting the team around you as well, and knowing exactly what to do. Income is very important as well from an assessment perspective. When you're working out debt serviceability ratios, so you've got PAYG versus self-employed. If you're a PAYG, 3 pay slips, 2 your tax returns. Self-employed, you need an ABN and GST registration for 2 years. So if you're self-employed, really what you need to do is make sure you are GST registered and have an ABN for more than 2 years. Company structures, very straightforward. 2 years income, assets and liability statement from the accountant, structure and directorship. So this is where you need an accountant to give you all those documents. So these are the documents that you'll be preparing in the event that you want to do some refinancing or apply for a new loan. Character, I'll bring this up initially. Character is very important because it really establishes the kind of person that you are and your pattern of behaviour in the past. Now, every time you go for a loan in Australia, whether it's commercial lending, residential lending, credit cards, broadband connection, mobile phone connection, there is a reporting agency called Vader Advantage, and this is a credit reporting agency. It's a privately owned company, but they actually hold a file on you. So anytime you go for any type of loans, they mark your credit file with the loan. Now, because you haven't consented to this information, they can't actually stipulate whether you were successful in your application or not. It just says that John Smith applied for a $500,000 loan with St. George on this and this date. It doesn't actually tell them whether he was successful or not. Why is this important information? It's important because if you're dealing with people that are inexperienced, like a mortgage broker who's new in the industry, and you are, in terms of your financial situation, in terms of what you want to achieve, it's not a straightforward vanilla deal. There's got to be some creativity. If you get more than 8 hits on your credit file in a 12-month period of time and you haven't taken up the loan, you cannot get any more loans. Now, most people don't even know how many hits. Who knows exactly how many hits they have on the credit file? There's only a very few of us. So the most important thing is, number one, your credit file is one of the most important things you need to have as an investor. And I encourage everyone to ring up Vader Advantage on that number there, 133124. Go to mycreditfile.com or vaderadvantage.com and just request a copy of your credit file. It's a file that will tell you exactly on all the types of loans that you've applied for. I've got many hits on my credit file where I haven't even applied for those loans because some mortgage broker didn't know what he was doing and he was shooting off applications to different lenders, seeing which one would stick. Okay, so it's important that you work with the right people from day one. Otherwise, what's going to happen is you're going to find out you can't borrow any more money and no one will tell you why. Now, the thing with your credit file also, if you're a serious property investor, I would encourage you to sign up for my credit file alert, credit alert, where you get an email and SMS even to your phone letting you know that someone has marked your credit file. Okay, this is a service that is tax deductible if you're a property investor, and it's really a service that everyone should subscribe to, especially if you're looking to bring on and build a large property portfolio. Now, the other most important thing about your credit file also is that if you have a mark against your credit file, whether it's a one-off and it wasn't your fault, as long as you're upfront about it and you write a letter to the lender or the financier explaining what actually occurred, you're on a holiday overseas or something happened that was beyond your control into one-off, most of the time, in some circumstances, we can get it signed off by the lender. It still doesn't affect your lending ability. So it's important to be upfront about it. Have a copy of your credit file when you're going for any kind of loans because they're going to check them anyway. You can't sneak through the system. They're going to actually pull out your credit file, and that's one of the conditions of the loan. So it's better to be upfront about it and to know exactly what you have on your credit file. Equity. How much will you put into the deal? So generally speaking, the banks will lend you 80% against property, residential property in Australia, and you can pretty much without any limit. Okay, so you can keep buying these properties as long as you've got a 20% deposit, they'll give you the other 80%. The moment you go above 80% loan to value ratio, you can still borrow above 80%, but you have to pay lender's mortgage insurance. And this is a one-off premium that you pay, which ensures the bank's risk against you defaulting or something happening to you where they've got to sell the property, but they've got more than 80% exposure in the property, and then they activate their lender's mortgage insurance. And in Australia, there's two main, there's others, but the two main lender mortgage insurers in Australia are Genworth and PMI, and also some lenders self-insure. Now, has anyone got more than 5 properties here? Yeah. Some investors might. The interesting thing is, what a lot of people don't know is that Genworth and PMI will cap you at 4 mil, generally speaking. So sometimes people say, I'm maxed out. And when I look at how they're maxed out, they've actually gone for the same kind of loans with either Genworth and PMI said no more. 4 mil is your limit. We're not going to give you any more lending. Now, they also have a file on you, and most brokers don't even understand this $4 million limit. It's roughly $4 million in terms of exposure. So as you grow as a sophisticated investor, your questions will change to not what the highest LVR is, but your questions will change into, I'm looking for loans that are with the lender's mortgage insurance that are underinsured by Genworth if you're maxed out with PMI. So as you grow, the questions that you ask will change, and the questions that you ask will largely determine your level of success. And that's really what happens with investors. And it's a journey like any other journey of any other, whether you're doing shares, CFDs, commodities trading, property, it's no different. It's just a system that you need to learn if you are going to be successful at it. You can borrow up to 100% loan-to-value ratio in the current environment, but you need to pay lender's mortgage insurance. And at the moment, there isn't any products that capitalise lender's mortgage insurance. So in the past, just to clarify, there were products that could capitalise lender's mortgage insurance. Now they're becoming scarcer. There's only a few left on the market, but I would say that they're really now the maximum is lender's mortgage insurance, which is capitalised at 100%. So it's 97% plus LMI. Inside the box and outside the box lending. So if you go to your local branch manager in your bank, what they'd like to see is full documentation, clear history, consistent stable income, full-time employment. Okay, that's what we call inside the box lending, vanilla lending. Now, you might be surprised, but most of our graduates don't fall into that category. They're out here somewhere. And this is why we have access to all these other creative type of finance strategies. So we have low doc lending, non-conforming lenders, vendor finance. We've done solicitors finance for clients. We've done credit impaired lending to some extent. We can't do miracles. We've got to still work within the lending environment, but we can provide loans to some people with credit impairments. We've had those impairments signed off by the lender. We also do no-doc lending. Now, no-doc lending is virtually completely gone, and I'll clarify what these mean in a second. So at the moment, we're restricted to really low-doc lending because of the subprime fallout and the effect on the market.